You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the network for you, the busy financial advisor or asset manager out there. We get it. You're busy these days dealing with your clients, as you should be. A lot going on out there in the markets, but maybe you're curious about the world of options and derivatives. Maybe you've already dipped a toe in those waters and wonder how deep you can go. You just don't have time to keep up with all the latest and greatest in the world of options. Don't worry, we got you covered here on the Advisor's Option. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network, which I just learned this morning. So big, we officially broke Spotify just last week. Our network, over 6,000 plus episodes of options goodness. Spotify can't handle it. It broke. So we have that claim to fame now. We broke Spotify. We are so big. So it has been fixed, thankfully. But now you can only get 3,000 plus episodes of the 6,000 plus on Spotify. So Spotify can't handle. They can handle Rogan. They can't handle the Options Insider Radio Network. So a fun feather in our cap there. If you want to see what all the fuss is about, make sure you're subscribed to the full network, not just to the Advisor's Option. Nearly a dozen shows coming at you over there. And of course, more all the time. And if you want more in your lives, and who doesn't, then head on over to the pro, theoptionsinsider.com/pro is the place to go to learn more about great pro Q&As. Our buddy Mr. Matt's been on there quite a bit in the past, as well as, of course, Options Oddities every week. Matt, ironically, has been on that show as well. As well as early access to a lot of great stuff, like all the great OIC content and a whole bunch more. TheOptionsInsider.com/pro is the place to go to learn more as we learn who's joining us on the old program. First, let's go out to the shores of New Hampshire. Yes, there is a shoreline in New Hampshire. It's hidden. You have to find it, but it's there, where we are joined once again by Mr. Matt Amberson, the principal over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the show. How good does it feel to be on the network that broke Spotify, sir?
That's a great stat. Another good stat for you, Mark. So I was just thinking, I go, God, Mark is probably doing, three shows. Like, where are all these going? Well, they're going up and they're breaking Spotify. So congratulations, Mark.
Yeah, we need to put that as a badge somewhere on like our social media platform. The network that broke Spotify. I'm sure they would very much like that branding, but it would be fun nonetheless. And it is indeed true. As we keep on rolling to see who's joining us on the old guest hot seat this week, we are joined by a newcomer to the program and indeed to the network, Arnim Holzer, the global macro strategist at Easterly EAB Risk Solutions. Arnim, welcome to the Advisors Option Program.
Great to be here.
Well, Arnim,
thanks for having me.
Arnim, as we are wont to do with all of our first timers here on the network, why don't you go ahead and give our audience a bit of an overview of your background, as well as what it is you folks do at Easterly EAB Risk Solutions. That's a long business card. It's a lot to say.
It is. I have over 40 years of experience in the investment field, from portfolio manager, strategist, multi-asset strategist, and options and volatility and correlation strategist across a whole bunch of different firms, Deutsche, Deltek Asset Management, Scudder, and now with and Neuberger and Berman, and now with the EAB Easterly Risk Solutions. Our firm is an options research-based RIA, so we provide very, very detailed research around options, around volatility and correlation, ways to profit and diversify portfolios. So not just looking at hedging, but also looking at ways of extracting value out of the market, and also ways of looking at risk, not simply as a lot of people have historically based on decline and volatility, but looking at it in terms of what we would call beta expansion or beta opportunity, which is looking at really incrementing correlation into the approach rather than simply looking at volatility as the only measure for risk.
All right. Sounds exciting. I think we have a lot to get to, so let's get to it, listeners. It is time for the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everyone, welcome to the P&L statement, the segment that was born of the pandemic because so many insane things were happening between every episode of this show. We spent a lot of time at the start of every show pretty much breaking it all down, so that became known now as the P&L statement. And since our last episode last month on the old Advisors Option, we've seen a lot of the same trend mostly playing out, maybe with a little bit of a hiatus over the last few sessions, but it's mostly been markets drifting up and vol drifting back down as it has been for some time now. Maybe, like I said, we're seeing a little bit of a break for that. Nvidia, some of the other big market leaders have been shedding some weight of late. Hasn't really turned into a heck of a lot of volatility yet, but we shall see. The week and indeed the month is young. But Arnim, as our guest, we will start with you. Obviously, a lot has been going on in the market of late. What is catching your eye out there, in particular from an options and a volatility perspective, sir?
Well, absolutely. And one of the things that I would also say is we also do manage a hedged equity approach called the Easterly Hedged Equity Fund. It's a 5-star fund. And it does actually look at systematically extracting the value from volatility and upside participation, because markets do have a tendency to go from the bottom left to the top right, but you want to be sensitive to drawdowns. And I think this is a perfect example, perfect time to talk about it, because you want to participate. AI is a meaningful trend, but the markets have become concerned about some of these divergences. You just talked about Nvidia and some of the big mega cap names that have obviously done very well. And regardless of the interest rate environment, In fact, some would say because of the interest rate environment, their good balance sheets and cash give them a nice defensive flavor. But the problem is that the expectation around earnings get fully priced up in a hurry. And unless you believe that this growth perspective is going to have a much longer moat, in other words, these companies are going to be able to defend their profit margins for very long periods of time, you do have to be reasonable in terms of what you pay. And it looks like we're getting to that. And to give you a sense, when you looked at the skew entering the year, in other words, how bullish or bearish the market was, both the S&P and Qs were, close to a couple standard deviations to the bullish. We know that, and I'm sure you all have been following it in your programs as well. Well, now you're down to about half a standard deviation bullish in the S&P, and you're about one standard deviation bullish in the Qs, which makes sense because of the momentum in some of these big names, and momentum has been a driver. But we're no longer seeing that 1.5, 2.5 standard deviations of bullishness in the options, which is supposed to be where the speculators have been the most aggressive. So I do think it does make sense to understand what the options are telling you. Clearly, they're not quite as aggressive as they were. They're not quite as confident as they were. And when you look at the way stocks are performing, we still see this very big divergence between the equal weighted, the small and mid cap stocks, and the market cap weighted, the mega cap. And that divergence has actually been getting worse this quarter. For a while at the beginning of the year, when there was hopes that the Fed would lower rates, we were beginning to see a hope that you could get that divergence, kind of converging, actually brought together. But actually it's not occurring, even in the face of some of the small cap names and mid cap names actually having better earnings growth forecast, but you're not seeing it reflected in performance yet. And I think that the skew on the option side is telling you that there's some skepticism.
Yes, we have been talking about the skew quite a bit of late on the network. It sounds like your reading of the skew then, Arnim, is that, let's say the bull run isn't exhausted, isn't maybe topped out, but maybe showing, let's say, some signs of taking a bit of a hiatus, a little bit of a pause. Maybe they're a little bit spent, Arnim. They need the respite.
100%. I think you're on the right track. The difficulty, though, is always how do you position yourself against that? Our fund systematically does it. It's a systematic. It's not a finger up in the air where the wind blowing. And so we're always basically having downside protection, and we're seeking to participate to the upside. But we're very short term, kind of 2 to 4 week put spreads, and we're very short term because if you get an event, you want to be able to participate. The difficulty for investors to try to manage that is that unless you have institutional size, it's expensive to do that. But I think there are ways, either through a fund like ours or through really looking at the things that look the most expensive and seem to have the be running into the most headwinds, and slightly position yourself for, whether it's selling calls or beginning to put in some put spreads at reasonable levels. We don't necessarily espouse tails, but we think it may start to make sense. And the reason for that is when you look at the correlations, even inside the S&P, when we look at the implied correlation of the S&P, and this can be somewhat complicated, but the idea is the way stocks vary against each other is normally in about the 30-40% of implied correlation and realized correlation. And that gives you a normal macro environment. A stock picker's environment might be below that. But right now, correlations, implied and realized correlations, are below 10%, which means that the market is telling you they don't think any of the market's performance is going to be dictated by macro factors. They're actually at as high an idiosyncratic or stock and earnings-based orientation as I've seen in probably a decade. And that tells me that the risks here are probably higher than people really understand. When you look at volatility, it seems like the water's not too choppy. 13.5, 14 doesn't seem too choppy. But when I look at the way stocks are performing and the expectations within correlations, it would tell me that there's no macro risk at all. And I think we can agree there's probably more macro risk than that.
Yes, implied correlation, or perhaps the lack thereof, has been a big focus on some of our other shows, like the Volatility Views. We've been talking dispersion trade is hot again. Very crowded trade right now. But you mentioned something that I want to go back to. You talked about put spreads in particular. Our audience, they like to get into the weeds on these things. So you mentioned you have a hedged equity strategy. Walk us through that. What is your methodology? You mentioned a couple week out put spreads. Is it, let's say, 2 week out put spreads? If so, how far out of the money are you going? And then also, what are you writing against it? Is it weekly calls? Are you in the 0-day? How do you construct your hedged equity portfolio?
Great question. So the fund is different from other hedged equity funds. It does use a put spread collar, which is where you sell upside in the form of, out of the money calls, and you buy out of the money puts or put spreads. We happen to use put spreads, and but before we even get to that point, we actually take, for every dollar, we add 30% exposure to the market, long exposure to the market, through a swap. So we now have 130% exposure to the market. And the reason that's so important and why it's so different from other funds is because that allows us to then buy defense 200% of notional in put spreads in the 1 to 2 standard deviation area. And that's typically 98, 93 puts. So we're long the 98, we're short the 93. When volatility rises in decline, we actually will spread that, because 1 to 2 standard deviations is wider than a 98, 93. It might be a 95, 103. 80, 83, or 95, 85. And that depends on the volatility in the market. But the idea is you want to defend 1 to 2 standard deviations. And the reason for that is tails pay off very, very, very seldomly. You don't want to defend tails because it's expensive and it's money that you often throw away. If you look at the success of true tail approaches, they bleed. By using a put spread that's 200% notional defended, we get an extra return in that 1 to 2 standard deviation area. We on the call side, we'll go short calls in the 2-week range. Our put spreads are usually 2 to 4 weeks. Our call that we sell, that we're short, is usually in the 2-week range, and it's usually in the 2 to 3% out of the money range. When vol is higher, as we talked about spreading the put spreads a little wider, when vol is higher, we obviously can sell calls slightly more out of the money as well. The structure does not bleed. It fully pays off for each other in that time frame. The reason this is important, and what I would really emphasize to listeners, is that when you buy those cheaper put spreads further out, or puts further out, what ends up happening is, if you get an event relatively early, a decline in the first month of a put or a put spread that you sell, that you buy a quarter out, you don't get the full effect. And so the name of the game, if you're systematic, is to be in that sweet spot, which is usually about a month, somewhere between 2 and 5 weeks. And that allows you, with tranches, that allows you to always have a piece of your put spread, your defense, that's always relevant and always will get a good maximized offset if the decline occurs. Because we're not doing very long dated, expensive, far out of the money, if the market goes up, our structure stays more relevant because we're short term. We reposition if the market goes up, which is it often does. We're able to reset and stay in that same 1 to 2 standard deviation range. If you buy, and it's very sexy sometimes for people to look at these 6-month and 1-year kind of tail puts. The problem is, if the market goes up 5 or 10%, what you bought at 20% or 15% out of the money in terms of puts is now 20 or 25% out of the money. And you need a cataclysmic move to even come close to paying that off. So we believe the number of times you monetize and the relevancy of your position is much more important than that ideal data point that you might get once every 5 or 6 years.
That's interesting, because we've had people on the show in the past who tend to lean much longer term in the hedge department. And you're right. The challenge with that, of course, is it doesn't respond to all these smaller shocks we see in the marketplace, which the clients want. The clients want protection from that as well. Now, of course, the challenge going the other way, nearer to expiration, where you're hanging out in the 2 to 5 week range, is, of course, as you mentioned, the bleed. There is that decay factor out there, which is a challenge. Now, you're also adding an extra layer on top of that, which is a swap. So you're adding extra outlay at the onset. It must be challenging to overcome all of that, Arnim.
Well, the swap is a very low cost vehicle. It's, on an annualized basis, it's 40, 50 basis points. It's not a very expensive cost. And because over time, the tendency for the market is to go from bottom left to top right, you're incrementing, pretty solid return. And it allows you then to keep 30% of your position uncapped. So we don't have bleed. We always participate because we always have 30% exposure that we don't sell We don't sell away. We're always careful to have 30% participation. Our historic participation rate with this structure, that's, by the way, a theta positive or an income positive, so it doesn't bleed. We usually have about 2 basis points daily of income, so it's a positive theta, and sometimes that can be in very volatile markets, that can be a 10 to 20 basis point coming into expiries. We can be collecting as well, but the nature of this is usually in the 50 to 70% participation rate, and the structure squeezes volatility down to about 40%. So what you're able to do is kind of bend the risk return of your performance signature, because you've got these extra places where you can get volatility return, you can get theta return, and you can then have underlying equity return.
All right, a lot to unpack there. I could see my co-host here, Mr. Matt, is champing at the bit to get in here. Mr. Matt, a lot to unpack there. We'll start with what you're noticing out there. I know a lot of our listeners like to check in on what your models are telling you right now in terms of vol and in terms of what you're seeing in the markets. And then B, Arnim just unloaded a bunch on us in terms of structure and how they go about setting up their hedged equity, and as well as his views on what skew is telling us out there in the market. So if you have any thoughts on all of that as well, have at it, sir.
Yeah, so there's a lot to talk about there. Definitely agree. About a week ago, that this, we do the implied volatility divided by the weighted average of the components implied volatility, and that got as low as I've seen it in a long time on mid-June, and it's since come back up a little bit, but still, very low. That's actually, as that goes down, that's usually a bullish sign. That's just, when you see that spike, that's when the market's going to have some problems. So that's been low, coming up. So there's a little bit of negativity from that implied volatility to the components. Contango, which we look at a lot, which is the front month to the back month, was really low, and now is starting to come up and creep up a bit. As far as macro events that we track on our site, there's quite a few coming up. It's been quiet this early in the week, and then Thursday morning has a few, Wednesday morning has a little bit. And then it gets quiet again till next Wednesday, July 3rd. My birthday, I'll have Mark, so you can start shopping.
Not quite born on the 4th of July, but pretty close, sir. Quite the American birthday. As far as the overall look, the skew, the put-call skew is nothing much to write home about. What I think is interesting, and we call it the meme effect, is it still looks like it's out there. Meaning that a lot of these way out of the money calls, 5 delta calls in the small stocks divided by the 75 delta, like 5 delta divided by 75 delta, is still very high. So there's still some call action out there, meme action. So that's what I'm seeing in the overall market, Mark. As far as hedged, obviously, I always want to be hedged, and there are various ways of doing it. And I think that the market dictates a bunch. I've even gone now with the volatility so low, you could buy like a 5 delta strangle and then sell some meat against it, but buy more of the strangle since it's so cheap. You could go out, so in these times when they're really discounting vol, I've seen it, 6% in some of those. You can, you just take some shots and buy some in case something happens. I'm talking like 4 days out, something, very short term. It's nice to be protected, as Armin says, closer to the strikes. I'm always talking about out of the money put calendars, out of the money puts, and that's true that they do. And then even the junk VIX calls,
that they don't pay off that much. But, again, it's still, they don't bleed. And it's still nice to have those in times of duress, because it doesn't need to get to those because of all the Vega and the curvature in the VIX calls. So, the put spread collar, does have some, advantages. We've talked about some of the disadvantages, the way markets tend to work, and being short some of those calls could, just, you don't want to have, all your eggs on that short call, because, markets tend to, get a large percentage of their appreciation in very few number of days. So you have to be very careful with those short calls. But other than that, yeah, quite a reasonable strategy. And that's where I'm sitting, Mark.
Ah, yes, your junk VIX calls. They're popular again. We'll get to that in a little bit, mister. I think you've inspired some people. But before we roll out of the P&L statement, Arnim, you definitely get the pride of place. I've been doing this for a while. As we said, we just broke Spotify, so we have a lot of episodes in our back pocket. You are definitely the first person to come on here and talk about overlaying and adding a swap into the mix out there. So you get pride of place for that, Arnim.
Well, I think what we really try to do, both in our institutional consulting and when we talk to retail investors and advisors, is we try to take what the market gives us. And I think, the discussion that we were just having is a great point. In you want to see how the market is overpositioned, and you want to try to benefit asymmetrically if that reverts, because mean reversion is a very powerful force. And at the same time, we also always want to make sure, and it's one of the reasons we designed our fund the way we did, is we want to make sure that we can monetize. One of the biggest problems that we see, and I'm sure you'll agree, in defensive positioning in puts, is that oftentimes people don't know how to monetize. And the longer you have your puts out there in terms of expiries, the more difficult and nuanced what you're going to do. Do you roll? Do you roll down? It's a very complicated fashion. And when you keep the expiries tighter, and this is true for the VIX too. By the way, when we talk about VIX, we like to do call spreads that are kind of tighter, usually within 30 days. And we'll do a spread that's, let's say 10, 15% out of the money to 30%, 50% out of the money. And we'll buy more units so we can really monetize that, and it'll expand when we need it to. But monetization is critical. And so where you see the market is at standard deviations of against forecast, then you can take advantage of that. And I think that's the way we really recommend investors not to just look at absolute numbers and say, oh, the VIX is too cheap, it just looks low, I'm going to buy. What you really want to understand, is it low to history? Or is the S&P low to history? Is it cheap? I think the point that was made, you were bringing up the 0 DTE, 1, 2 DTEs have changed option selling, have made option selling much more powerful. And as a result, I think it until we get some kind of a real shock, vol is going to have a tendency to be sticky low. When that breaks, though, I think it will be pretty significant. But at the end of the day, we want to focus on what can we monetize, what allows our investors, whether it's hedge funds, mutual funds, or our retail and advisory clients, what helps them monetize more consistently, because that seems to be an enormous problem.
You invoked the debate topic of the day, Arnim, which is 0 day. We've done many episodes on that. I'm sure we could do the rest of the show on that. Sounds like you're a fan from what you're putting down there. Have you thought about migrating any of your liquidity into the 0 day, maybe even using them as the call portion, the override portion? Where does 0 day fall into your structure right now, Arnim?
It's not a part of our mutual fund. It's not a part of the hedged equity structure. It forms part of the discussion and informs a lot of the discussion that we have around events that we see on names. If you see skew, if you see really unusual forecasts of volatility that's not earnings oriented, sometimes you can start to position. It's not only meme stocks. It's also a way of understanding that some people seem to have an inkling about something, and they're willing to speculate in those kind of 0, 1, 2 day frameworks. And so the fact that there's more liquidity there, and there's it allows you to actually take some signals that maybe there's something else going on. And so that it's actually not all bad. It doesn't necessarily mean that we're going to advise our clients to speculate there. I think more of our clients, particularly on the institutional side, like the idea of selling some of that vol because they think it's a little bit casino-like, where people are taking maybe some foolish positioning and they're taking advantage of it. But I think there are some times where you get some signals because people are willing to play in some names where it's no longer earnings related. There's something else, and there's an event, there's a study, there's a competitive announcement, and maybe you didn't make the connection, but now you see it because you have something that flags it for you.
All right, we have to keep rolling with the show, but you invoked 0 days. I think I'm legally obligated to ask you. It's been quite a contentious issue for a while now. What exactly is the impact of this explosion of 0-day volume in big index products like the S? Some people think these things are exacerbating vol and they're leading to these big end-of-day 70 handle rips like we've seen lately in products like the S. Other people think maybe they're muting vol, which is one of the reasons why vol has remained so low for so long. Where do you fall on the net impact of these 0-day contracts, Arnim?
I tend to see this more as liquidity for options and selling, because I think the institutional firms, the market makers, are more than willing to sell into it. And I think, they understand actuarially what their risks are and they can hedge themselves. So, I would tend to see this as potentially having a little impact on skew, potentially, but not necessarily really being that disruptive. That's my off the top of the head.
All right, listeners, we could talk 0-day the rest of the show, but we have to keep on rolling right on into the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the earnings volatility report.
All right, listeners, welcome to the earnings volatility report. Another segment that was born of the pandemic because we were crunching all the numbers here with Matt and his team, and it became apparent that nobody cared about earnings vol anymore. And now fast forward a few years, and how the worm has turned. It seems like everybody cares a lot about earnings volatility these days. Matt, when you're not talking to me, crunching the numbers over there, we are coming to the tail end of yet another, I think the technical term is explosive season on the earnings vol front. We've been crunching this data for some time, many years now, and our long-term average has already skyrocketed to 109%, which I do believe is the highest we've ever seen since we've been crunching this data. And this cycle said pshaw to that, coming in at 117% right now at the end of the cycle. Of course, listeners, all that showing that if 100% is even, if everything moved in line with what their straddles were pricing, 117% shows a substantial amount of outperformance. Yet again, this cycle, I know, Matt, you've been looking for earnings vol to matter again for some time. Seems like that is the case right now. What is catching your eye out there? What were some of your surprises and takeaways from this season? And then what are you looking forward to for next cycle, sir?
Yeah, we called it. We thought it was going to be, when you see volatility low and you see people really talking about earnings and guidance problems, et cetera, it's going to be a good earnings season for holders of straddles. And of course, when we price the straddle, it's not just looking at the straddle, but we price the residual straddle value, so we can isolate very well what is the actual implied move that is being spoken to us from the market. So we do, we think a good job of isolating that, and it kind of shows off. We've been pretty close to even over the years, but we saw very low performance, as you say, in around the COVID crash, and that time, because it just didn't matter as much. It was so volatile that the earnings weren't as meaningful, but now it's a lot more meaningful. And we called it. I think what was interesting about this last session was how much the stragglers move. Usually those are pretty well. They're smaller. They tend to be smaller stocks. but they really moved a lot. And I had a couple trades on, and it's pretty shocking how far things moved in those late weeks. Usually we term the earnings season as a 6-week period. We kind of throw all the 6, 7, 8, 9 week into the 6 week, but because there's so few and they're straggling. Like the next, for example, now we have 5 days left in the month, and then somewhere around maybe the 12th or so of July is when the next season starts. And so, we're going to start this all over again. And the stragglers are really kind of popped and from the last season. I wonder if that's going to carry over. And again, what I usually, July, people think, oh, it's summer and everything, but the earnings really do tend to drive a lot of volatility around, especially the second, third week of earnings, after the initial wave of earnings people reporting. So that's what we saw, like you said, usually 100% is a, kind of coin flip between winning with straddles. And we saw 17% winners for the straddle holders in this last earnings segment, which was very high. I think there's only one that I can remember that's higher. I'm not going to call that it's going to be more this next season. We'll have to see what the overall market's doing. But if the volatility is low, definitely earnings is going to be a driver and probably most likely profitable to the straddle owners, Mark.
Yeah, how funny is it that we can actually say that with some certainty now? One of the reasons we started crunching these numbers so many years ago was because we got that question all the time. Should I buy vol or should I sell vol heading into earnings? And we always said it was a coin flip. And it still is that to a degree, but you definitely have to be biased long right now, given the way these numbers are playing out, which is fascinating. And again, a very recent, very new development, listeners, which is fascinating in and of itself. Arnim, I'm curious for you, how much of a driver in your analysis is everything we're talking about here, earnings, volatility, and the impact out there? Or are you folks at Easterly more focused on the broad macro trends?
Well, for the fund, which is really meant to be a very strong risk-adjusted volatility and equity participation approach, we don't do that. It's the very straightforward leverage put spread collar that provides a very nice sharp Sortino ratio drawdown defense and upside participation. But in our institutional business, it's the discussion that we were just having is very relevant. And in fact, some of what we do, and investors might be interested in doing this, is we don't just look at the earnings response to history. We also look at the earnings response to the bellwethers, or what I like calling the cornerstone names in their sector. And when there are macro conditions in effect, what you often find is some of these names, whether it's, ExxonMobil or Walmart or Home Depot, there are different names that kind of serve as direction. They're a little bit lighthouses to help. And what we found is that sometimes the moves are not simply the fundamental, the underlying company move. It's also, there's a move that's attributed to or associated with the bellwether in the sector. And so I would always, recommend that investors see if those correlations are reasonable. We run those for our clients because there can be some information there to really understand the individual stock in the context of its sector and the directionality of its sector. But I also think there's a lot of wisdom in what we were just talking about in terms of understanding that the post-pandemic and pandemic period was a very unique period. And some of that earnings data is not going to be as relevant now that we're in a different kind of economic environment. So I think that was very, very strong counsel.
Fascinating stuff indeed, but we have to keep on rolling, listeners. It is time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everyone, welcome to The Buzz, the portion of the show we break down some of the hot option stories, trends, and developments going on, again, in the world of options that you, the busy financial advisor and asset manager, maybe you missed because, hey, you're busy doing your day job, which is answering that phone when your clients call. One of the big ongoing discussions that we've been having on the show, again, ever since the onset of the pandemic, shows how much the pandemic really did change things in the world of options. Post-pandemic, the ongoing story, the ongoing narrative has been, can this volume surge, this influx of new options traders, can it continue? Matt and I, we both faded it early on. We thought this is kind of just an aberration. Everyone's at home now. Trading is the new national sport, but everyone is going to go back to the office, and these volume numbers are going to come back down. Lo and behold, we were proved wrong. I think we were both happy to be proved wrong. We stopped fading it after that, and year after year now, it's been record after record. Just this year, really in March, we saw one of the first real downturns we saw year over year in quite some time. March was a bit of an aberration, obviously, because March of last year, of course, was the contagion fear month, so volume and volatility hit a bit of a near-term high there, so not exactly comparing apples to apples this March versus last March. By the way, if you want more people's insights into how all of this volume trend is unfolding right now, make sure you're checking out the interviews I did down at the Options Industry Conference a few weeks ago. Most of those are hitting the network. A lot of them have already hit the pro, and they're making their way out onto the regular on-demand network right now. If you want to hear what the exchanges, what the brokers, the trading firms, everyone else out there has to say about whether this volume trend can continue, we went deep into that as well. So make sure if you're intrigued by this, you should check those out. And we have the numbers now in our hot little hands for May. Hard to believe we're already going to have June in our hands in about a week. June just flying by out there. So did May continue the trend? The answer was yes, but ever so slightly, up about 3% total volume out there. Some interesting evolutions within that once you break the numbers down from our friends over there at OCC. ETF options actually down nearly 6% in May, which is kind of dragging on the whole there. Equity options, also interestingly, another kind of bleak spot in the market. Last year, if you look at the overall numbers, obviously the market was up. It was a record year volume-wise, but equity options were actually flat. They were almost down on the year. So equity options, surprisingly, were up in May, 9.5%. Index options, you expect those to explode now because 0-day is just dominating everything. Those were up nearly 5%. And even our old friends of VIX Futures up about 3.4%. So it was a decent month overall with a few dark spots. ETFs kind of dragging everything down, bringing the total number to up about 3%. That said, we're still threatening 1 billion contracts in a month. I said it not that long ago when we had our first ever billion contract month. I said, this is a sea change in the world of options. We never hit 1 billion before, and it seems like we're going to be doing it with more regularity going forward. And now, even on a somewhat modest month last May, 977 million contracts was the total. So even at a modest month, we are within spitting distance of these record pivotal levels like 1 billion out there. So it does seem like we are on pace to have another record year. The year-to-date ADV is 46.8 million contracts. That's per day, listeners. That's up about 5.1%. So if that just rolls forward through the end of the year, we are on pace for yet another record year. Mr. Matt, you and I have been talking about this for quite some time. I think both of us have not faded this in a long time. I'm happy to be proven wrong on my skepticism for this volume trend. What are your thoughts? It looks like maybe the concerns for March were a little bit overblown. That was kind of just a blip, maybe a bit of an aberration. May, not the strongest month, but still getting it done, sir.
Yeah, my call was that it was going to be lower, but what I forgot to do is look back. Last May wasn't that big. It did the same thing, kind of marched up, and there wasn't that much option volume. Same thing with June. I think it's going to be pretty close to what May is. It'll probably be up, but it won't be that strong. When we say strong, that's the billion. So yeah, that's how I'm seeing it, Mark.
Arnim, same question for you. Obviously, you're knee deep in the options world these days. I'm sure you were surprised and or intrigued, like the rest of us, when you saw this volume surge just become unleashed upon the market. The fact that it has continued for 4 odd years now has been fascinating. What are your thoughts on this ongoing volume growth we've seen in the world of options? And I'm curious for you, This last month, up only 3%. Have we started to plateau, or are we maybe just taking a pause before the next leg up, sir?
Well, I mean, I think the change in the interest rate environment is going to make the holding of underlying positions more expensive, right? Margin loans become more expensive. And so options become more attractive on the basis of capital efficiency. And so part of what I think we've seen has been that when you raise interest rates, people are still going to find a way to meet their speculative need. And it's probably going to move more that way because margin debt is not cheap and it's more expensive than obviously Fed funds. So part of this really makes sense because the leverage is just really significant when you take into account how expensive a margin account is. And that's why when you see people say, oh, there's all this unused margin. Well, I think that's very expensive money. So options certainly are attractive from that point of view. But the other point of view is that you've got a whole host of new names in the last 2 or 3 years, not just the meme names, but you've got a whole host of new names that are very hot. You've got these NVIDIAs, you've got the big mega cap names associated with AI and the chip names associated with AI. And so these new names have to get filled in. All those expiries have to get filled in and provide opportunity, and probably are not trading as efficiently as they should be. And so there's room for people to come in and disintermediate. I look every day at my block trade monitor, and I can only cover, I have probably 100 names that flash in, but it's hard to cover more than 25 names well. And when you look at these names, these are huge trades for incredibly expensive names. And it is really overwhelming when you see that there is tremendous need for this. But the other side of the coin is that institutions are also seeing that there's tremendous retail appetite. And in some cases, I think where they see, as we were talking about before, they see volatility, maybe, skew, maybe getting a little too bullish, they're willing to sell out of the money calls. They're willing to take those positions. And so the nature of the interest rate move has done some of it, but also the nature of whole new classes, whole new series of assets that didn't historically have options. I'll give you a perfect example, the utility sector. The utility sector is a wonderful defensive sector, but it's a great long-only sector. It's historically not been a super option sector. But if you look at the last year, you look at the independent power producers, those names have garnered a lot of options attention. And you're seeing growth in utilities because of the IRA. So there's secular changes to sectors that are now having to be filled in. Those expiries, those options lines have to be filled in. And there's interesting positioning, and there's actually real growth there. So I think that's part of what's happening here as well. It's not simply zero DTE. It's not simply interest rates. It's that there are some secular changes that attract new investment.
We had someone say on the network a couple of years ago, and it's still true today, we wanted new people to discover the world of options. We just didn't know they were all going to arrive at once, and that's pretty much what happened. And we're still dealing with the ramifications of that. But you know what? These are all good first world problems to have. Now, speaking of the buzz, other things going on, hot breaking stuff here on the buzz this episode. Arnim, you cited this one as well. This came across our radar as well. The Journal diving into our waters this week, putting out an article. And by the way, this headline gets points for just the most clickbaity headline ever. It's titled, "These hot new funds are, quote, boomer candy for retirees." Man, they're working hard on the clickbait front over there at the Journal. I'll have to give them a hard time next time I chat with those folks. But the focus of the article is something that is indeed near and dear to our hearts. And if you listen to my conversations down at the OIC, listeners, came up a lot in our conversations as well. This massive influx we've seen, kind of going hand in hand with what we were just talking about. We've seen an influx of volume, but we've also seen an influx very recently on new funds and ETFs that are taking advantage of the derivatives markets in interesting new ways. A lot of them attempting to do what we're talking about here on the show, offer these types of buffers and protections or collars or things, and doing them in let's say, sometimes better, sometimes worse ways out there, usually charging an arm and a leg to do just that, but also generating a lot of volume as a result. Arnim, I know this article clickbaity as it is, it came across your radar and you had some thoughts on it. So let's start there. For our listeners who haven't read the article, why don't you summarize it for them? And then what are your thoughts on, as they term it, boomer candy for retirees, sir?
Well, the first thing is that, you know, after 40 years in the business and no one really caring what I did, there are a lot of people that all of a sudden care about what I do, and that's kind of fun. The critical point that I think the article really made is, you know, yes, you're right. The different funds use different approaches to try to mute volatility and still participate in equity returns. But the point that I thought was really interesting was this idea of diversifying in a time when portfolio diversification is hard to find. So right now, if you look at whether you look at IEF or TLT, the IEF is a very short term, it's a 5 to 7 year treasury bond ETF. TLT is a 10 to 20 year treasury bond ETF. The correlation of those to the S&P and to QQQ, you know, to the NASDAQ, are extremely high. They're about 40%. And historically, they've been negative, but they're actually positive now. And over the last several years, they've cycled between positive and negative, but the last couple of years, they've been mostly positive. That means that your diversification and your blended asset management and your asset allocation is not really going to protect you much. The second part of this that's very odd is that fixed income, when you look at 10-year treasuries, for example, the volatility of 10-year treasury is almost equivalent to the volatility, the VIX, you know, to the S&P volatility, which means when you blend your fixed income and your equities, you're not even getting diminished volatility from an aggregate portfolio point of view. So what people are looking at these hedged equity funds, and ours certainly works very well in this consideration, is this idea that you are able to create diversification that has that ingrained protection, because the put spread collar or the puts or the put spreads are going to work when the market goes down. So whether fixed income works or not, you never really know, and correlations can be unstable. But in this environment, it is a way of getting more ingrained protection that's systematic than hoping that bonds will be negatively correlated when you need them to be. And I thought that piece of the article was really on spot.
We've always said on this show, Arnim, that at the end of the day, the only contractually guaranteed inverse correlation is a put option. And so when you have that in your back pocket, it can work in your favor. Mr. Matt, I'm curious, did you see this clickbaity article, the Boomer Candy article, and what are your thoughts, sir?
I did not until you brought it to my attention, but you know what I'm seeing a lot of is some of these very short-term, high-yield ETFs, and it just spells trouble. It does remind me of Volmageddon. So, I mean, I don't have much to say other than, if it looks too good to be true, it is too good to be true, Mark.
Yeah, the crux of the article, listeners, and again, I encourage you to check it out if you are intrigued. It is entitled, "These Hot New Funds Are, quote, Boomer Candy for Retirees." And it talks about these derivative strategies that they're incorporating in a variety of ETFs. They talk in particular about a lot of these effectively collar type ETFs out there and the efficacy or lack thereof of some of them. The intriguing thing also is that this obviously goes back to what we were just talking about, the volume trend. Not just in these funds are driving volume because they need it for execution purposes, but also the thing that surprised me coming out of the Options Industry Conference this year was everyone I talked to pretty much on the institutional side was giddy. I think the only word I could say, giddy, about flex options again. I was stunned. I never thought I would go into an Options Industry Conference in the year 2024 and have everyone talking to me about flex. Talk about old, but that is the hot new thing out there with 0 day. Every big exchange group is now spinning up massive improvements to their flex functionality. Why? It's for exactly this reason. These derivatives-based ETF funds out there are doing a ton of flex options, mostly in reversal conversions. I won't get too deep into the weeds on why they're doing that, but they're using these effectively to offset what they're doing and minimize some of the exercise and assignment risk therein. So we're seeing massive amounts of volume going up in flex that we never really saw before. In some names, there's more OI now in the flex than there is in the listed options, which again is just completely backwards to my mind, but that's the world we're living in right now. And a lot of it is driven by these quote unquote boomer candy Just cracks me up. These boomer candy ETFs out there. So fascinating stuff. Again, another plug for my conversations down at the Options Industry Conference this year. Man, we had a lot of fun on the show. We're already coming up against it. But before we get out of here, didn't have a chance to even get to our mid-year question office hours palooza. Maybe we'll squeeze that in on the next episode. But Matt, we had to get in on this on the buzz here because it looks like you have corrupted our audience yet again. You were talking even very recently on our Pro Q&As, I believe, about some your favorite, the old quote-unquote junk VIX calls. In particular, I think you were talking about the AUG doubles at the time. They were trading for around 55 cents. Allow me to submit for your approval, sir, what we were just talking about on the option block on Monday, which is someone coming in and picking up, only 63,000 of the July 65s. They did those for 4 cents. So getting a little bit nearer dated, but also going about 10 handles beyond what you used to term junk out there, doing it for 4 cents. I know these trades are part of, ratios and 1x5s and things, so they're not exactly what you see on the surface, but it made for some interesting fodder for the show and indeed for our audience. So we put it out to them. They are the ultimate arbiters at the end of the day of all things. And we said, where do you fall on this whole junk VIX calls strategy, quote unquote? We gave you 3 choices, actually 4 choices out here. We said, junk VIX calls, they can work, they can pop on occasion, or they are a complete waste of capital, or I don't care, they're just a hedge, someone's just hedging a portfolio, I don't really care what they're up to. Or you prefer it more on the kind of ratio backspread front, which is kind of how I tend to like them. But right now, Matt, the reason I say you have corrupted our audience is that 61.5%, they've obviously been listening to your appearances on the network, sir. They have chosen that junk VIX calls can work. Those can pop, sir. So you have infected them. 23.1% say it's a waste of capital. 11.5%, they say it's just a hedge, doesn't really bother them. And 3.8% only prefer it as a backspread. So, Mr. Matt, what do you think? Corrupting young minds for a future generation, sir?
Well, as Socrates did, I'm not going to defend myself. He of course, was convicted of corrupting the youth. And he didn't fight it and took the hemlock. So I'm going to take the proverbial hemlock on this one. The last show, I just went back as I'm wont to do. I didn't make a trade based on it. It was the Augie 55 VIX calls, and I'm basically still even on them with nothing happening. So that's the thing I like about these calls is they don't decay away. If you pay, I think I paid 15 cents for it, and it's still about that. And then again, it doesn't need to get all the way to it, and you're going to double, triple, quadruple, or more with these things. So they're nice to have, especially when everything's so cheap. It allows you to do some other things against it, knowing that you are long some vol. So I think you have a smart audience there, Mark.
Corrupting young minds for a future generation out there, Mr. Matt. Well, unfortunately, that music means we've come to the end of another fun sojourn through the world of advisors and options. Man, we touched on a lot of interesting things on the show today. But before we go, Arnim, if our listeners are intrigued, they want to know more about anything you were putting down there, like, let's say, the hedged equity portfolio, where should they go? What should they do to learn more?
Well, Easterly Funds has a website that would be the right place for them to go. Their advisor probably knows of the fund, which is the Easterly Hedged Equity Fund, it's not too hard to find us if you're interested. It's Easterly Advisors and Easterly EAB Risk Solutions.
There you go. Check them out. Easterly Advisors is the place to go to begin your journey. And Mr. Matt, they want to begin their journey into the world of back testing or analysis, or maybe they want to hang out with Otto. Where should they go? What should they do, sir?
I knew you were going to say Otto one time in this, and I was right. And because of you, Mark, we're adding Otto to our website. You could ask Otto anything about ORATs, and that's just because of you.
I have literally created a monster, sir.
Interactive Brokers is now hosting our backtesting iframe. If anyone has a website and is interested, let me know. We have 181 million back tests that is in that iframe. So it's very cool. You could sort through and find the trades and the ones that are working in today's environment. So very cool. Come on over to orats.com. Matt at Orats is my email. Everything's good over there at ORATS, and now Otto's going to be much more famous because of you, Mark.
We broke Spotify. Pretty soon you're going to break IB with all those back tests. You keep it up, Mr. Matt. So check them out over there, listeners. Orats.com, ORATS.com, the place to go to kick the tires and light the fires, or just give them a follow on the old Twitter at OptionRats, all one word. A very memorable handle. A lot of great data coming out there as well. Speaking of great data, last but not least, check out our friends over there at the Options Industry Council, optionseducation.org, the place to go to learn more. They have data on a lot of these things we were talking about, studies, and a whole bunch more, webinars, all sorts of fun. So if you're intrigued, and they have a whole section for advisors over there. So if you are an advisor, you want to learn more on behalf of your clients, that's a good place to go as well. That is going to do it for us on the network today. Back again throughout the rest of the week with our usual array of content. And then Matt and I will be back again post-haste for another episode of The Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.